Hello, everyone. Welcome to the weekly roundup. Today we will cover monetary policy, earnings releases, and market sentiments. Hello, Ben.
Hey, Eva.
How's it going?
It's going good. It's a rainy day here in Ottawa, but otherwise good.
Yes, and it's expected to last for like 3 days.
Nice.
Yeah. Is there an ark somewhere, like a Noah's Ark, we need to run
Yes.
to?
Jeez, exactly.
Great. Let's enjoy the weather.
Yes, exactly. We had a great summer, so I guess yeah, we get a bit of this in the fall. It's okay.
Yes, it is time.
Yeah. Yeah.
Okay, we're gonna start off with, the most interesting news of the week. Both the BUC and the Feds cut rates yesterday, as expected. But did their statements reveal any new insights or surprises for investors?
Yeah, great. Thanks. Yeah, was those that was the highlight of the week for sure. I think as expected coming in, it was 100% likelihood of a Fed cut, and they went ahead. Canada was closer to 90, but still went ahead with it. Quite a bit of mixed reviews from Canada. Some research is saying that they're suggesting that potentially this is the end. Others say there's another one or two. We seem to line up with the view that there's another one coming this year. And that's really on the back of what we've been talking about the last couple of weeks, is we think the unemployment numbers continue to rise in Canada. And so it's, they have multiple jobs, these central banks, but North American central banks have that view where they have to, or their objective is to provide price stability, and their other objective is to provide stable employment. And so I would say that likely they continue to cut rates in Canada because unemployment continues to rise. And that's just on the back of slowing economy. The Canada-US issues continue to be an issue that they have to tackle. And so I'd say we continue forward from that perspective, and that's generally what we think. In the US, um, they have some other issues that they're dealing with. I mean, they're also starting at a much higher point. We're already down at 2.25 after that cut, and they are at 4.25. So they're significantly higher. They got much more room to bring things down. Their inflation is maybe a little bit higher. There's an argument to be made for higher inflation because of the tariffs that continue to be put on there. Right now, most of that's been ate by the companies and not being passed on to consumers. So maybe that'll potentially change at some point. Unemployment's ticking up a bit in the US, but they're also having, they're deporting a lot of people. So it's been kind of neutral, I'd say, generally in the jobs market. But I think Chair Powell seemed to indicate that he continues to be concerned about, we'll say, slack in the economy. But he continues to worry about unemployment as the priority. And so I'd say rates continue to come down in the US. If you look at forward rates, you're looking at something like 1 to 1.25% lower over the next 12 months. And if the new Fed chair comes in May and aggressively cuts rates, that could be different. But between now and then, there's lots of ground to cover.
Okay. So a follow-up question I often get is, what do these rate cuts actually mean for our credit cards, our mortgages, auto loans, your savings account, in both the US and Canada?
Yeah. Yeah, so on the many scales, so first, if certainly one of the biggest things that people have leverage on is their homes. So if you're in a variable rate mortgage product, then your cost just went down by 25 basis points. And so you probably are paying down your principal faster, or your payments getting reduced depending on where you have where you've borrowed your money from. On the credit card side, zero happens. They continue to charge you 20%. So no changes there.
Oh,
On the auto loans and any other consumer loans, that means rates are going to get a bit more attractive. The central bank reduces the overnight rate, which means that anything that has a variable rate product, those rates get better. On the kind of the longer dated things like 2 to 5 years, it really has zero impact. The market has a pricing mechanism already built in, so when they cut rates, the market's already priced in what they expect for 2 to 5 years. So I'd say zero change there. In the US, slightly different on the mortgage side because their mortgages are based off the long end. And so, like in Canada, where you get a mortgage that has, like, we'll say a 0 to 5 year mortgage rate on it, you still amortize over 25 years. That you have to roll it over, 4 or 5 times throughout the cycle of your mortgage. Where in the US, when you buy a house, you put a mortgage on that, you have 30-year amortization and you have a 30-year guaranteed fixed rate. And so the long end in the US is still pretty high. So we're probably in the 6.5, 6.75% range, which is pretty high historically. And so that's acting as a bit of a drag in the US housing market. So that'll be important to watch. And my view still is that at some point the central bank will do what they've called in the past Operation Twist, where they sell their short dated bonds and then they buy the long dated ones to push down the long end, and that provides stimulus to the U.S. housing market and the U.S. economy as a result of it. But it really is the variable rate products that it has the biggest impact on. And to your last point is, what does it mean for savings? So savings in Canada would have come down with the interest you get paid. Savings in the US would have come down a bit, but it's still better, like the savings rate in US dollars, because they're at, we'll say 4%. You still get paid more to have money in US dollars versus Canadian.
Okay. Um, so about the markets, earnings season is in full swing. Were there any standout numbers or surprises that caught your attention?
I mean, to the downside today, we had Meta or Facebook announce a big investment in AI and quantum and forward-looking types of things. Zuckerberg's done this perpetually, and at some point, I guess I'm not surprised. But the market always does this, is they under appreciate the forward investment that he's done and accomplished perpetually over the life of Facebook. And so they don't like how much money he spent. So the stock's down 10% today. Historically, if you've looked at this, if you stretch it back for the life of Facebook, every time they've had a big miss like that, it's been an opportunity to look to buy the company. We're certainly starting from a higher level because Facebook's had a good year, or Meta, excuse me. But historically, when you get a big blow off like this, where they don't like some of the numbers, stock gaps down 10%. From a technical perspective, it went from, close to being overbought to oversold today. So that'd be something that I'd be reviewing and saying, do we drop a bit lower? Do we base for a while before we look to maybe acquire it? But historically, this has been an opportunity when, the market doesn't like what he said, but it's not because he's doing anything silly. It's because he's reinvesting in the business and making sure that they have the ability to continue to grow.
Yeah. Let's see the charts.
All good?
Yes.
Okay, so we are recording here on October 30th, Thursday, October 30th, around 1 p.m. So anything that happens between now and this time next week, we'll comment on next week. But I wanted to hit off on a few things. So the last couple of days we've had lots of attention towards what's happening with China and the rare earths. And I thought this is a great chart just to think about that. So world China has a stranglehold on rare earths. So if we look at this, mining of rare earth minerals by country 2024, obviously this is China, which is the lion's share, a little bit US, and then others. And then if we look at reserves by country, again, China by far, China, Brazil, India by far has the most amount of rare earth reserves. Why anybody should care and why it's irrelevant is because this goes into basically everything that we use today, which would be our cars, our computers, our cell phones, anything that has some type of processing capability would require some rare earths into it. So we would have seen yesterday Trump and Xi had some kind of agreement settlement, we'll say. The US reduced the tariffs on China. And China in turn said, We will put we'll say the stranglehold on the market for the next 12 months. We'll give you 12 months to figure out how for us to come to an agreement. So really important, really critical, and I think interesting to pay attention to is China has put themselves in a solid position to control what happens to technology over the next little while. So German industrial bloodbath. So when we think about the world and we think about Europe particularly, we generally have thought about Germany as really the industrial, I'd say, thoroughbred of the European economy. And so I think it's interesting to look at this. You know, they've really struggled. Rates have come down in Europe. ECB continue to stay on hold today. They're at 2% overnight rate. You know, they do have a bit more room to go lower if they need to. You know, Germany, for lack of a better term, kicking and screaming, didn't want the euro to some extent, but the weaker euro was a huge tailwind for the European or for the German economy the last little while. However, because of the pressure on the auto industry and other pressures, Germany's come under a huge amount of up downside pressure in their industry. I mean, one of the things that I think is relevant to think about, though, is the economy is not the markets. And so the German markets have done quite well. But when you look at the breakdown of how this has played out over the last 30 years, this is something to be concerned and cautious of. And potentially a weak euro can result in a positive tailwind for the German economy. The last one is financial forecast. So when we talk about financial forecast, it's important to look forward because this is probably the question I get more than anything is where do we go from here? And so this is a great breakdown of what's happening or what we expect to happen over the next multiple quarters in both Canada and the US. And to your point, Eva, just talk about what does this mean going forward. So, you know, we continue to think that overnight rate stays pretty flat once we get down to the 2%. So we think there's another 25 to come. And then what does that mean from a savings perspective? So a moderate downtick in savings. And then on the fixed side of things, and this is where mortgages would be linked. So if you look at like a 2-year mortgage, today you're probably at like 4%, something like that. If you look off into the future, we only think maybe a little bit 10 basis points or so lower on that side of things. So the market's pricing in a relatively flat yield curve as we move forward from here. I'd say that one of the call outs on this screen would be we are anticipating a stronger Canadian dollar, and we'll see what the argument is for that. But part of that is stronger oil, and the Canadian economy is starting to pick up at some point next year. So anticipating a stronger Canadian dollar at some point next year, and that'll be an important piece to watch. If we look down in the bottom, as I said, the financial forecast. So Fed was at 4.25. They're now at 4, and we anticipate they get down. Well, we say 3.5 here. Market's actually pricing in more than that. They're pricing in a full 1% by the end of next year. And so I think this would be a great thing to watch and pay attention to. But to the point just around overnight savings rates, you know, if you have your money in short-term bonds in the US, you're getting maybe 3.5 versus a 2 in Canada. And so I think this is and continues to be a very important aspect of what happens from here. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. I've prepared this report, and everyone's risk tolerance is different and should be reviewed. If you have any questions at any point about what we discussed, either feel free to reach out to me or speak with your advisor. As always, everyone's risk levels are different, and I appreciate you looking at the charts with me today.
Great. Thank you, Ben.
Welcome.
So, what's on the agenda for next week?
Well, we get into a new month and a new year for many. So tomorrow is the last day of the fiscal year for most of the banks, pretty much all the banks, and our business as well. So next week could be a new fiscal year, be the start of November. And so there would be lots to see and pay attention to. You know, we've had a pretty good month in October again. in the markets. And so we'd be looking ahead, saying what happens, continue to look at earnings. Tons of companies reported this week, to your point, and another huge chunk of companies report next week. So we'd be watching in earnings. And I think that'll present some opportunities for buys likely through there. And the last piece, which is something that you and I discussed earlier this week, which is sentiment. And so sentiment's sitting right there in that middle. From that 0 to 50 or 0 to 100, we're hovering right in the middle. So that tends to signal that the market wants to go higher. And the last piece, which we didn't comment on this much this week, was money supply. And so money supply be, I think, an important piece to watch because the US government's been shut down. And so they have been using their liquidity to pay their bills. And so we'd had a period of time where money supply had been increasing, and now we've kind of been sideways, which is effectively tightening into the financial system. While we think it's temporary and we think the government comes to an agreement by mid-November, and expect the money supply tick back up into the end of the year, we'd be watching those metrics quite closely.
Okay, great. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and will be in your email if you have subscribed. For our clients, please reach out to me if you have any questions or if you'd like to book a review meeting with Ben. Thank you for listening and have a great weekend. Bye.
Thanks, everybody.